Hello and welcome to the latest session from our US series. Today we're going to be discussing themes in direct investing into the US, kindly sponsored by Katten. We're joined by two of the Katten team, Matt Sperry and Giles. We're also joined by Lincoln S. Ellis from Northern Trust. So we've got a terrific panel to discuss some of the key trends and themes with you over the next hour. We've got a great international audience dialed in today from many different parts of the world. We'd love to hear from you in the chat, see where you're dialing in from, get your comments and questions into the chat and Q&A, and I will bring them live to our panel as we move through. So it'd be great to hear from you as we go along. Get your questions in for our panelists so that we can get your queries answered. But just to open up the topic today, we're going to come to Lincoln Ellis. Good afternoon, or good morning for you in Chicago, Lincoln.
Morning, David. Good to be with you. Brooks, Matthew, thanks so much for having me join you this morning.
Terrific. So Northern Trust have commissioned a family office benchmarking survey that's just been published. You shared with me some of the key headlines. Perhaps you could just tell the audience a little bit about the survey and we can get into some of the details in respect of direct investing shortly.
Yeah, absolutely. So we commissioned the 2020 benchmark survey, which was published in the fall of last year. It canvasses a cohort of our 500 plus families in 30 countries around the world, of which direct investing is obviously a topic of great interest and very much top of mind. And most of that, we think, comes from a couple of different angles. The first one is that many of the folks that we have the pleasure of serving in this group and our audience as well are made up of entrepreneurs. And so their propensity to continue to be interested in the sort of inner workings of business remain very high, even after a liquidity event. The second, of course, is that in long duration asset pools, direct investing and private equity programs more broadly make up a very significant part of these family balance sheets. So there's a natural affinity there. And then finally, and not to be underestimated, are the expectations for future returns of diversified portfolios, which if you look out across broad capital market assumptions like the ones that we produce at Northern Trust, they will appear to be paltry, particularly to any sort of entrepreneur relative to their business that has been getting, a 20 to 30% internal rate of return or return on equity or return on investment, whatever the metric is on a go-forward basis, given where valuations are. The choice to do direct investing of one sort or another is very high.
Okay, one of the stats that jumped out of me from the report was that 98% of the family offices you survey had an allocation to alternative investments, the broad term that would encompass all those styles that you mentioned, with an average allocation of 37%. So quite a big weighting, reflecting all the things that you said. But perhaps you could just unpack what we mean by alternatives. What are the investments that sit underneath that?
Sure. So in the broad alternative investment categories, you would see hedge funds, real estate funds, direct real estate investments, private equity funds, direct private equity, co-investments, and then direct operating entities. There continues to be sort of a third allocated to public market equities in both the developed and non-developed countries, and then usually a modest allocation to cash. But that large allocation to alternatives more broadly is really reflective of family offices' moves over the course of the last 3 decades to match up or line up with broader endowment and foundation or long duration asset pool investing styles. And that's really that's really created a lot of what we've seen, and certainly Brooks and Matthew are much more familiar with this than this tidal wave of activity that has gone on in the private and direct investing stage. It's also worth noting for our US and Canadian audiences and for those interested in the United States, the regulatory environment post the tech crash in 2000, Sarbanes-Oxley, and a number of other regulatory issues will have pushed again, been an amplifying effect for capital coming into the alternative space more broadly, but I think direct investing more specifically.
Matt, just to bring you in, I mean, you're nodding there with Lincoln's comments. I mean, is this reflecting what you're seeing in your practice working with family offices?
Yeah, I've seen these trends for years. There's been, I mean, you look at family capital, certainly global family capital of large families. It's almost like private equity funds, and obviously a lot of that capital, or a significant amount of that capital, comes to the United States. And whether it goes into private equity funds, hedge funds, direct investing programs, real estate. We see a lot of clients invest in real estate. It's coming to the U.S. for whatever reason. I think I think over the last year, it's been a little more difficult because I think everyone's been waiting to see kind of what happens with COVID. But I think now, at least a number of my clients are now looking to dip their toes back into the U.S. They've had capital sitting on the sidelines for a long time. They're looking at depressed COVID valuations, and they want to do some deals. So we're seeing clients getting to be more active, and I think that's going to continue over the next few months and then over the year. Thanks.
I mean, Lincoln, this survey was conducted, I suppose, during COVID times. What do you think the impact will be? For clients who are sat in cash looking for opportunities? Are these numbers reflective of that, or do you think that's still to come?
No, they're very much reflective of it, and they're very much reflective of the opportunity as described there by Matt. In fact, I spent a fair amount of time yesterday with a real estate group that is looking at distressed properties across the U.S. in the hotel space, right? So if you think about the areas that have been impacted by COVID the most, you think about the sectors, and then if you think about the geographies, where have the discounts already been sort of baked in? Where are they still dislocated? And how can an investor, either themselves or with a partner, directly garner access to higher end projects that will benefit from the COVID snapback? I think it was interesting to think about some of the comments and developments in the vaccine over the course of the last 24 hours, and what we're thinking about or seeing in terms of efficacy in the developing economies, where there are also interesting places to do direct investments and what have you. But the real tidal wave of money does, as Matthew described, continue to hit the shores of the U.S. for jurisdictional reasons, for also all kinds of reasons. But this is very much reflected both in our survey and what we continue to see in conversations as we begin to emerge in the post-pandemic period.
Okay, thank you. I mean, Brooks, just to bring you in, I mean, you're predominantly a corporate lawyer doing transactions. Have you seen these kind of trends with, cash-rich family offices or other types of buyers moving in, trying to complete transactions? What have you seen on the transaction side through COVID? Has it impacted your practice?
Yeah, so through COVID, the deal market generally pretty much went away in the first half of 2000. I think that there was a study that just came out recently from JP Morgan on M&A trends during 2020, and April was one of the quietest months in the last 5 years. And then the second half, it came roaring back, and the fourth quarter of 2020 was actually, believe it was 19% higher than 2019, which itself was a record year. So as far as just overall activity goes, yeah, it's been, the pace has been incredible over the last 5-6 months. And in that mix, we have seen a lot of offshore money trying to come into US deals. Frankly, we see more of it at the bid stage than we do at the closing stage, which is something that we're going to talk about a little bit later on. But yeah, there's certainly a significant amount of interest, and the difficulty is translating that interest in getting into transactions and actually getting to successful close on those transactions using offshore money.
Okay, thank you. And Lincoln, just thinking about the overall asset allocation for a family office and the illiquidity of some of the alternative investments. I mean, how do you kind of help family offices understand how look at the liquidity spectrum for these different investments and make sure that they don't, you know, become exposed to market volatility through having a portfolio that's too illiquid? How do you consider things in that respect?
Yeah, I think the technical term for that is getting out over your skis, right? I think, you know, you always want to, in families, particularly when they're at the beginning stages of this process, beginning to make private equity investments, beginning to make private credit investments, looking at additional direct deals. It's super important for folks like myself, Brooks, Matthew, et cetera, who are looking after and trying to understand exactly what the family is trying to accomplish, to manage those liquidity expectations thoroughly because of, David, the volatility that you've just suggested. And obviously over the course of the last couple of weeks relative to movements in the US 10-year Treasury, the movements in real yields across Europe, et cetera, we are experiencing some of that volatility in areas that perhaps we haven't in the past. In fact, I would argue that what we have seen, not only in this benchmarking survey, but across our work with family offices more broadly, is that this, in fact, is part of the reason and the rationale for investing directly in companies. They understand the volatility of the sectors in which they're getting involved. Whether it's real or perceived, a better grasp on the volatility that they're willing to accept in the business risk part of the equation. And I think that's not to be underestimated when people are advising folks on making these kinds of investments on a go-forward basis, is that business owners or successful entrepreneurs are very willing to accept volatility in their own business in a very different way than they are when they hand over money to public market equity or fixed income managers. And so again, I think that's the reason why you continue to see dramatic interest in this space.
Okay, many thanks for that. And Matt, now just to come to some of the tax considerations for foreign investors. I mean, we've got a question from Roddy Balfour that I'm going to come to in a sec, but let's just set the scene by asking you about some of the tax considerations foreign investors should understand when making direct investments into the US.
Sure. So when clients approach me to invest in the United States, we have a general conversation about the tax landscape here. And obviously the initial focus for many clients are income tax. Everyone's aware of US income taxes generally. What kind of tax leakage can I expect when I'm investing into the US? And it's really a function of the type of business, the type of investment you're making, and the structure that you're using inbound into the United States. So if you're using, for example, a partnership structure that's going to flow up to a trust or an individual, you're generally going to be looking at rates of up to 37% under US tax law right now. I'd be remiss not to talk about the fact that the taxes likely will change here at some point under the Biden administration and Democrats controlling both houses of Congress. So I think that that could probably increase to 39.6%, which was the rate under President Obama. So there'll likely be at some point a small uptick in the individual and trust rates. We also have capital gains taxes at 20%, but the nice thing for most of foreign clients that they're going to be exempt from taxation on long-term capital gains, so 0% tax. The notable exception being real estate, which is obviously a very popular asset class for a lot of foreign investors and family investors. So the next would be corporate. If you come in a corporate structure, the good news is in the tax reform in 2017, the rates went from 35% to 21%. So our corporate rates right now are pretty low and pretty much on par with capital gains being 20%. However, like the individual and trust rates, those likely will be increased under any kind of Biden tax reform. I think that the number that's being thrown around right now is 28%. And actually, I know in the UK that I saw last night that they're going to increase the corporate rates in the UK. So it seems to be a trend around the world. But we'll have to see. But the issue, so I will say post post-tax reform in 2017, we've been moving a lot of clients into corporate structures for a number of different reasons. Obviously, with the rates coming down from 35 to 21%, that's a good reason. Another reason, a lot of non-US clients of mine do not like filing personal tax returns in the United States. And so corporations will block that problem. So the corporation will file a tax return instead of rolling up to an individual or trust. But the issue is going to be is if you have to take out dividends out of the U.S. in a corporate structure. So if you have an investment where it's going to throw off cash flow that you're going to want to pull out of the U.S. periodically, there's a second layer of tax on dividends, and for foreigners, it's a 30% withholding tax. So subject to reduction under treaty. So, but if we don't have a treaty and you're paying tax at a 21% rate, and then you're paying another 30% tax on the dividend, it's effectively a 44.7% tax rate. So it can be quite high.
All of a sudden, Matt, it seems like my public markets portfolio looks okay if you're getting taxed.
Yes. There's many tools to lower those rates, and obviously it depends on when you're using a corporate structure. It very much depends on whether you need to take money out of the U.S. on a frequent basis, or you're reinvesting it in the U.S., or if you can wait till the end of the investment, the exit, and then liquidate the structure, then we can avoid that second layer of tax in many cases. So it depends on a lot of factors. My general goal is if I can get clients at a federal level to be taxed, 0% to 21%, I'm pretty happy, and generally the clients are as well.
Absolutely. I'll just bring that question in from Roddy Balfour. It looks quite specific, but let's see how we go. So question for Matt. Until Trump tax changes in 2017, we set up a complex US structure with portfolio debt to mitigate. You can see the question, can you, Matt?
I can't see it, but I'm following it.
FIRPTA on NRA investment in the US real estate. Okay. What's the best way to minimize that tax these days? So the FIRPTA.
So FIRPTA, we were going to get to that later. We'll talk about it now. So that's a 15% gross withholding tax. When a foreign person owns real estate in the U.S. and sells that real estate, the buyer of that real estate is required to withhold 15% of the gross sales price and pay it over to the government. And it's a refundable tax. So you can file, because in many instances, 15%, say 15% of a $10 million building, you're talking about $1.5 million can go into the IRS. In many cases, that $1.5 million paid to the IRS greatly exceeds the amount of tax that would otherwise been paid because of the gain. So the issue is you've got a timing issue. You can get the money back, you file a tax return, but say you sell in January, you're not file a tax return until next year. By the time you get your refund, it's a real issue. So you can structure around it by using domestic corporations as your seller, and that works in many cases. You can get a withholding certificate if there's going to be over withholding through the IRS. But so there are ways to do that. I don't know where the portfolio debt comes in, but portfolio debt in Roddy's structure, but portfolio debt's a great tool that if your client's not going to control the investment, you can use portfolio debt to invest in the United States, so it's debt, but there's no withholding tax on the interest. And so normally interest would be subject to 30% withholding tax unless you had a treaty that reduced that. But nothing's better than zero, right? So if you can use portfolio debt to invest in the U.S. or use a combination of equity and portfolio debt, it can sometimes work very nicely. So provided you don't control the investment.
Okay, thank you. Well, Roddy, I hope that gets to the heart of your question. Lincoln, just to bring you back in, I mean, if people are looking at direct investment opportunities, one option is to sort of buy the building or buy a business that the client likes, but there are obviously people can go through the various instruments to get that same kind of exposure. So if someone was looking at real estate investments in the US and liked a certain type of asset, what are the other alternatives that they would go to if they were looking at going through different instruments and funds that they might be considering to give them that same kind of exposure, but with a different kind of upside?
I think this is, I mean, the core of your question, David, is one of specificity. And I know in our planning meetings, we talked a lot about, trying to be a little bit more clear than other kinds of conversations that have been had in this broad neighborhood, because it is so broad. So what do we actually mean when we say direct investment? Do we mean owning an apartment in New York City or Los Angeles? Do we mean owning a manufacturing facility outside of Chicago? Or do we mean investing in a co-investment vehicle which follows on other investments that are made by general partners of private equity firms that we're already investors in? There are many ways in which I was just sort of listening to Matt talk about the tax structure issues and thinking about there's a similar sort of, mouse maze of ways in which families garner exposure to various types of opportunities. And it comes in direct co-investments, it comes in dedicated co-investment funds, it comes in follow-on offerings as an LP in existing private equity GP structures. Oftentimes one can come to an investment consultant or an investment advisor to put together a custom direct investment program. There are many ways in which families have used both a combination of both legal and structuring advice, which Matt and Brooks represent, and then investment advice from folks like ourselves to try and unearth where those opportunities are in any given series of sectors and or again, which is important to this group, multiple geographies. And so we see and entertain and due diligence a fair amount of these. We have experience across all three of the major structural ways in which families get access. And so, continuing to figure out, and I think this comes back to Matt's point, some of the structural ways in which you access may be affected by some of the tax consequences that sort of stand on the backside of that decision. So make sure you're talking to both of us together before you get to Brooks to do the deal.
Okay, and a good tip there. And Matt, just coming to you, the tax considerations on real estate, give us an overview there of what the special considerations are for investments in real estate.
Yeah, well, Roddy's question brought out a bit of it. So it is, and as I said earlier, real estate is an exception to the general rule that capital gains generated by foreign individuals or foreign taxpayers are exempt from U.S. tax. So gains on real estate will be subject to tax in the U.S. as effectively connected income. So basically, foreign investors are on par with U.S. investors, except for FIRPTA. So FIRPTA is the tax law that basically requires buyers from foreign sellers of U.S. real estate to withhold 15% of the gross sales price and pay it over to the government. So those are the principal differences. The other principal difference is when I have clients that are buying real estate to rent. So rental income in the U.S. is normally subject to 30% withholding on a gross basis, which for most taxpayers is a disaster because you don't get the benefits withholding tax. You don't get the benefits of depreciation, deductions, interest, all the expenses that come along with the property. So most clients will elect to treat that rental income as ECI, effectively connected income, file a tax return here so they can pay much lower tax rates on the rental income. And so those really are the principal differences. And as far as there are ways you can structure around FIRPTA by using, like I said, domestic corporations to be your vehicle that holds the property. So you have a U.S. taxpayer that sells. Of course, the U.S. corporation or LLC that you treat as a corporation will have to file tax returns. The taxes do get paid. You just don't get hit with the 15% gross withholding tax.
Okay, thanks. And what about for owner-occupiers? And what are some of the risks around tripping over and becoming U.S. resident by not managing situations correctly?
Right. Well, we have a lot of clients that have personal use properties all over the U.S., New York, certainly Colorado, California, Miami. So this comes up frequently. They're actually relatively easy to structure. The key we worry about, and I think we'll get back to this later, is this estate tax. Is exposure to estate tax if the personal use property, or really any asset, including any direct investing assets or securities that a foreign investor acquires, making sure that is not subject to an estate tax when the foreign individual passes away. And so the estate tax is 40% rate at the headline rate, and the exemption for a foreign individual is only $60,000. So while me, Brooks, and Lincoln have $11.7 million exemption right now, a foreign individual only has $60,000. So when they're acquiring a $5 million condominium in New York, $60,000 doesn't go too far. So we really need to deal with that exposure. And so how we do that is usually through a foreign block or corporation. So we have the client set up a foreign corporation in a jurisdiction like Cayman, Jersey, Bermuda, wherever, and then hold the property through that foreign blocker either directly or more likely through a U.S. LLC that we would treat as a corporation for tax purposes for a couple of reasons. And so that will block the estate tax if it's set up correctly. And then also we worry less about income tax because this is personal use property, unless they're renting it out. If they're renting it out, there may be little tweaks to the structure, but it's generally pretty simple. But the key is to do it correctly at the beginning. And there are so many clients, foreign clients out there that hold structures and hold properties in their personal name. I've got a client right now. He's Chinese. He must have $250 million of property here in the U.S. all in his personal name, and so we're trying to fix it right now.
Wow. Okay, and what about taxes? State income taxes. How do they factor in here?
Yeah, well, they definitely factor. So you have to be when you're modeling your deal or whatever investment you're making in the U.S., you need to look at if it's something tangible in the state, you need to look at the state income tax regime depending upon the state. Now, a lot of my clients, a lot of foreign clients love to invest in New York and California in particular. Those are unbelievably high tax states. New York, the headline, the top New York state income tax rate is 8.82%. New York City adds on additional tax, and then California is over 12. And so when you add those to the federal rates, the tax rates can creep up pretty high pretty quickly. States like Florida, Texas, there is no state income tax we have to worry about. So it is absolutely imperative when you're doing the analysis on any deals to take into account not only federal income tax leakage, but also state.
Okay, and I mean, you mentioned at the top the popularity of corporate structures, but just perhaps give us a sense of corporate structures versus partnerships, and what are the main kind of considerations that people think of there?
Well, it's tax rates, because the tax rates, well, depending upon where the partnership, where the UBOs ultimately end up in the structure and what they look like. But if the UBO going through a partnership structure, because a partnership is transparent here in the U.S., if it goes up to a trust or individual, the rates are going to be up to 37%. Since that person's going to have to file a U.S. tax return on effectively connected income. So that's different from a corporation. A corporation pays 21%. But again, when that corporation pays dividends to its shareholders, there'll be a second layer of tax. So really, when I'm looking at a corporate structure, you compare the 37% to an individual or trust versus 21 to a corporation. It's a huge disparity, but you really have to take into account, am I going to pay dividends? How frequently? If you can wait to pay out the dividends and liquidate the corporation at the end of the investment and not pay interim dividends, which many investments work that way, you can avoid the second layer of tax if you do it correctly. So it just depends on the income stream, what the use of the cash. Those are the principal differences in tax. The other difference, I think, as I talked about earlier, is a corporation will block U.S. tax reporting, whereas a partnership will not. So many clients, I think less clients today than maybe 5 years ago, but many clients don't want to file U.S. tax returns. They don't want to hear from the IRS if there's an audit. They would rather have a corporation block that liability and that risk. And so a corporation will do that.
And although it's still the impact is still going to be feeding through, but what's the impact of the Corporate Transparency Act on investors considering US?
Well, we certainly have had a number of clients look to the US over the last probably 5 years as a refuge of privacy, and really because, as probably most of the people in the audience understand, is when you form a LLC in the US, there's no public disclosure of its members or its managers. A corporation is a little different because the directors will be public, or partnerships or trusts. So most business entities in the U.S., when you set them up, they're private, and they can be private, and they're meant to be private. And I think it's generally because there's been an attitude in the U.S. that you have a right to privacy if you're wealthy or not, and I don't need to know, or shouldn't know, what you own. Now the U.S. has become under significant pressure by the OECD and the EU in particular, due to our unwillingness to sign on to CRS. And so I think I don't think that the U.S. will sign up to the CRS in the near term. And I think if anything, the Corporate Transparency Act almost makes that 100% likely, I'd almost say, because this was the answer to the world of us having these private entities that could hide nefarious transactions and money laundering and those things. So basically, what the Corporate Transparency Act does is it's going to be a private database maintained by the government of UBOs, certain UBOs and control persons of LLCs, of privately held LLCs, corporations, most business entities. Amazing, no, not to say amazingly, not trusts though. Trusts aren't covered by the rules. Trust raise a number of issues in the rules, and it'll be interesting to see how the regulations deal with LLCs in particular, owned through trust structures that run up to UBOs that are beneficiaries of trusts. So effectively, there'll be private reporting to the government of UBOs. And the UBOs are 25% or more beneficial owners, but either vote or value, and then control persons. So I think if you have managers of LLCs, would jump out to me, directors of corporations would have to be reported. So they'd be reported to the government, and when those people changed, that you would need to file with the government to change who those people were. It will be accessible to U.S. law enforcement agencies. It will be accessible to foreign governments under tax exchange information agreements, under other treaty like provisions. There are substantial penalties in there for the government, for government officials violating privacy. I do think that when they came out with this act, and I'd love to hear what Brooks or Lincoln think about this as well, and add to this, I think the government was very concerned about unauthorized use of this information and getting into hands where it would jeopardize individuals and our clients. So it'll be interesting to see how this plays out. I do think it's going to take some time for the government to put this together. I think regulations, the first regulations aren't supposed to come out until the end of the year. There's going to be so much public comment by people like Brooks, Lincoln, our law firms, financial institutions on what these things should look like. And then even once they have the system up and running, I think for existing entities, we have 2 years to report. So we have time to kind of see how this plays out.
Okay, thanks. I mean, Brooks, just to bring you in, do you have a perspective, anything to add in respect of that Corporate Transparency Act?
Yeah, it's interesting. I'm actually, I find myself as part of the drafting subgroup within the corporate department on the Corporate Transparency Act, trying to update our purchase agreements and LLC agreements for it. And I think that the biggest area from my perspective as a sort of technical deal execution practitioner is going to be allocating risk. As Matt alluded to, there's some words in the statute as adopted that are not defined, and depending on how you apply them, create the substantial amounts of uncertainty as to who's actually responsible for what. Hopefully the regulations will clear it up, but I also anticipate a fair amount of litigation about it. I think that, for example, there are a couple places in the act where it uses the disjunctive of, owned or controlled, or owned or advised. And it just begs the question, what does control or advise mean? And does advise mean that I actually have to have a relationship that's established through contract that I can prove establishes the advisory relationship? Or is it, we get together for cocktails once a quarter and you tell me what you think, and that's enough of an advisory role to become an exempt entity so that you're not subject to the reporting requirements? But because the way the reporting requirements work, each reporting company is responsible for reporting its own beneficial ownership. Well, if you're a private equity shop that's that has just purchased a portfolio company and you're inviting a bunch of co-investors to come into the portfolio company, your portfolio company that you control is responsible for the beneficial ownership reporting for all of your co-investors. So you're going to want your co-investors to represent to you that they have provided to you all of the information that they need to in order for your investment to comply with its obligations under the statute. How you do that, how you enforce that, and it's not necessarily the initial investment that's the problem, it's the updating, right? Because when any information changes with respect to a reporting company is obligated to update it. Well, how do I know, as the private equity shop, when something has happened with one of my co-investors overseas with one of its UBOs, as Matt points out, that triggers a reporting obligation, an updating obligation on my part? Unless I've got a contractual obligation that I can enforce against my co-investors, I have no stick, to enforce, to make sure that I'm satisfying those obligations. So there's going to be a lot of back and forth, I think, between investors, control investors and co-investors and others on, what all this means. And there's some odd little pieces to the legislation too. They've taken out the concept of bearer certificates. They've seemed to have preempted US state law. I don't know anybody who still uses bearer certificates. I think that probably went away in the 80s. But to the extent anybody is out there using bearer certificates, they are no longer eligible to be used in the United States. So little tidbits that are just going to come out as people get, as the regulations come out and people get more familiar with the statute, and it actually starts to work its way into documents. People are going to be, I think, much better versed in what it means. Right now, it's just as Matt pointed out, it's just a big black box. We're waiting for the regulations. We're waiting for a comment period on it, and eventually we'll figure it all out.
Okay, thanks, Brooks. And just looking at the macro picture, I mean, we were discussing earlier, there's a new administration in the US, there's increased appetite and lots of bilateral trade between different countries. I mean, where do you see the sort of bright spots for foreign investors looking at businesses in the US? Where do you see demand springing from that's of interest?
There's a lot of distressed assets right now. There are a lot of businesses and industries that were hit by COVID in the United States that haven't fully sprung back. It's going to be an interesting time figuring out which businesses that got hit by COVID are resilient and which businesses were frankly disguised buggy whip makers, so to speak. They were on the downswing from a macroeconomic perspective, but nobody really realized it until it all fell off a cliff, and maybe they'll never come back. One of the big ones is, if you run a business that specialized in servicing commercial office space in downtown areas, you are going to be in a period of significant consolidation because that market has shrunk, and it's not guaranteed that market will come back in the near future, if ever. So that's a hard spot. But anything right now, any technology solution that helps people deliver services, remotely, through the dispersed world we find ourselves in, for example, right now, those are going to be hot, and they're going to be hot for the foreseeable future, and a lot of money is going to come into them, which is interesting because they are right at one of the tension points from a US statutory perspective on overseas investing, which, I don't know if you're ready to get to it, but that is the Committee on Foreign Investment in the United States, or CFIUS. And it's funny. I've been practicing for over 20 years, and I've heard it throughout my career and I'm going to pick on investment banks because lawyers like me love to pick on investment banks. Whether it's said as certainty of closing or closing risk, that is one of the things that people always talk about when you're talking about executing on an M&A or an investment strategy. People want certainty that the deal will close soon, and when it closes that the cash will actually be there. And I think there might have been some historical bias against foreign investors because of cash controls or just cultural issues generally. But in recent years, it's come to a really fine point because of CFIUS. CFIUS is it's a cross-departmental ad hoc, essentially, committee. It's comprised of representatives from various federal departments, the Office of the U.S. Trade Representative, the Director of National Intelligence, and it's intended to ensure that foreign entities do not take control positions in areas in the U.S. economy that are of interest from a national security perspective. It goes back all the way to legislation that was passed in the 70s. I think it started with the Exxon-Florio Act. But it's come to a head through recent revisions in FIRMA in 2018, which both expanded the scope of the act and imposed a new mandatory reporting regime. There used to be that all of the reporting under CFIUS was voluntary. You would have to look at the transaction, look at the players in the transaction, determine who was foreign, whether those foreign players had control, so to speak, of the investment, and whether or not, in your judgment, it was an area that was of national security importance, and then you would make a voluntary filing with CFIUS, which had 45 days to respond. Oftentimes the response was not enough information, give us another 45 days, which you would. And you would just have to work through their requests. Some of those requests are difficult to actually answer, and they're oftentimes on a timeline that is very tight, 3 business days, for example. So under the voluntary reporting regime, CFIUS involvement in transactions was few and far between. The examples of transactions under the voluntary regime that were overturned, there were only a few. The biggest one was the Smithfield pork transaction, because it's such a large supplier of food to U.S. Defense Department. All their packaged meat product comes from Smithfield. So, another odd one was there was a real estate investor who was looking to buy a large tract of land in Nevada that just happened to overlook the U.S. Naval Proving Grounds where they test weaponry. That transaction got nixed, as for reasons you can imagine. But with the expanded scope and the new mandatory reporting, there's a lot more action going on with CFIUS, and especially because the mandatory reporting regime focuses on 3 places where we are seeing the most interest from overseas investors. They refer to it as the TID, which is technology, infrastructure, and data. If you are investing in an area of technology that has potential sensitive impacts on national security, or you're investing in infrastructure that has national security implications, or you're investing in any company that has access to data on US citizens that could be misused in a manner that would adversely affect national security, you are obligated to report the transaction under CFIUS, and it is a mandatory 30-day prior to your anticipated closing date reporting period. Well, the issue with a lot of US transactions is that they move so fast nowadays. Going from signing up your LOI to actually closing the transaction could conceivably be under 30 days. Having to layer in a 30-day CFIUS approval period under the mandatory reporting regime will cause a lot of investment bankers to say, sure, bidder A and bidder B are proposing pretty much the same terms, and maybe bidder B is offering a little more cash, but bidder B is coming from overseas, which means there'll be a CFIUS filing, which imposes closing risk. So maybe you want to go with bidder A instead. Maybe some of that is unconscious bias because investment bankers only get paid if a transaction closes. Maybe some of it's actually sincere concern about the real closing risk, but it's something that you have to be aware of. Now, the key is the US government only cares about foreign investment if it's a control investment, right? So a lot of this is not an issue if you are investing as a co-investor, you're doing minority investments in a transaction where the control investor is going to be a U.S. person. You can even have a a substantial stake in the economics of a fund as long as the fund is being managed by a U.S. person and the fund is making the investment. These are all things that are they're difficult to suss out, and the best thing you can do is, and I'm going to quote a criminally underrated movie from John Travolta, the movie Basic. You have to tell the story right. You have to be prepared for the question. You have to have your beneficial ownership reporting ready to go. And you have to have the story about why either this is not a national security connected investment, or if it is, why you're controlling it as an overseas direct investor does not create national security risk to the United States. Certain investors from certain jurisdictions are given preferential treatment. Canada, Australia, for example, they generally speaking are subject to a lower threshold than investors from other locations. I would say the nightmare scenario for an investment banker is a state-owned or state-affiliated operating company. If you have a corporation coming from China and there's any appearance that either the PLA, the People's Liberation Army, or the CCP, the Chinese Communist Party, owns a significant interest in that entity, and the transaction involves anything in the TID area or anything else of national security importance, forget it. You're not going to win the bid. But you're welcome to play. You will not win.
Brooks, I can't resist the opportunity to follow on a John Travolta quote, but just to emphasize this point of yours that I think is material, particularly given the way capital structures have developed in the advent of late stage growth funds in the venture space, where this TIB related set of issues is quite active. And we know from our relationships with those general partners that these CFIUS related issues, particularly as it pertains to their limited partners and or co-investors as you move into this growth equity neighborhood, has very much been on people's radar screens. And so I'm glad that you brought that last piece up, particularly about the domicile of the GP and who the actual control party is, because we have certainly had conversations with people who were interested in but shied away from because of these reporting related issues. And we also have had relationship with GPs who maybe overtly or passively have suggested, maybe bring us US people, et cetera, et cetera. So, and for these are clear business case operational efficiencies and speed to close related issues for the general partners or direct investors. So again, this is a very material point. It affects the kinds of optionality in terms of deals available to clients from a global perspective, and really a meaningful set of issues to negotiate.
Yeah, and I think it emphasizes the fact that, and this is a little self-promotion, but I think that these type of clients really need to have a team that includes, someone like Brooks, someone like Lincoln, to really, guide them when they start looking in the U.S. as to these types of issues and how they can get ahead of CFIUS and to how to plan to really execute a deal that's going to actually close.
Okay, I mean, Lincoln, just coming back to you, if there's headwinds through things like CFIUS putting people off these kind of transactions from abroad, if they're looking to access other types of private equity through accessing the best kind of funds or the funds with the best kind of track record and performance, are there issues around that, they might miss out on certain transactions of direct investment, but are there always other ways to kind of synthesize that, kind of return profile, or are there issues actually accessing the best kind of funds because they're already kind of fully allocated or at capacity?
Well, I think as Matthew and Brooks have suggested, that the answer is there may be issues. In many cases, general partners have both for the fund level vehicles as well as their direct co-investment opportunities have structured and paid a great deal of attention to and time with folks like Brooks and Matthew to organize slices of the investment capital structure that allows for those kinds of investments to take place. So the good news is for folks on this call and in other places who might see this on the replay is that from an opportunity perspective, part of what was being unpacked in the earlier part of this conversation by both Matthew and Brooks was around the US being sort of this unexpected place for foreign investors to come and be quote unquote transparent, or at least known entities, or using US tax and legal related structures to form entities that allow them both the kinds of privacy that they are accustomed to and the flexibility to make the kind of investments, David, that you've just asked about. And so I would say, again, wanting to avoid sort of this, sounding like a commercial for Brooks, Matthew, and myself, the level of complexity that foreign investors in the US, and quite frankly, very wealthy US investors as well, really calls for a full investigation of both the structure of and what the ultimate opportunity looks like from an investment perspective. So conversations like this one, we hope, will be useful to sort of surfacing what the broad-based issues are, and that it can then follow down the various channels with us.
Thank you
for additional information. Yeah.
So we're coming into the last 8 minutes of the webinar. So please do put your questions or comments in the chat. It'd be great to use the opportunity to pick the brains of this panel here. But I mean, Matt, just to bring you back in, I mean, on the privacy point, I mean, privacy is such a major issue for family offices and private clients. The confidentiality side, we had a raft of new reporting and exchange of information kind of regimes, a few years ago. Where are we now with all of that? How do clients kind of protect privacy in priority to the tax is one element, but privacy is a major element for international investors?
Sure. Listen, I think that the U.S. is still going to be a place you can remain private with your affairs, not secret, not secret in the sense of, hiding tax evasion or hiding that type of activity. That's going to be an issue through the new Corporate Transparency Act, and it's an issue with bank due diligence. And I onboard foreign clients into banks and all the time, and we're always dealing with the KYC and AML issues. And U.S. banks are much better equipped to deal with these issues than they were, and much more savvy than they were probably 7-8 years ago. So but I still think that even with the Corporate Transparency Act, this is a place where you can still remain private with your affairs. There still won't be public disclosure of owners and managers of U.S. LLCs. The database will be private. And so I think that's unlike some areas of the world that are getting pressured to have public databases, which I think are a bit dangerous for a number of reasons. And I don't think that's going to come to the U.S. And again, I think CRS won't be coming to the U.S. As a result of, I didn't think it was anyways, but I think as a result of the Corporate Transparency Act, I think I'm pretty, I don't see us signing on to CRS. So I think that the U.S. is still a good place to remain private.
Okay, thank you. I mean, Lincoln, for the US family offices you deal with investing abroad, I imagine they're considering things like currency, and that's a big part of whether they're deciding to make direct investments abroad. I mean, how might a US client look at sort of currency risk as something that is there when they're constructing their asset allocation, thinking about that?
So unless it's so let me start by saying that the majority of direct investment from US folks outside of the US is in direct real estate, and it does tend to be for residential purpose, not for income generation. Outside of that, people are generally, given the percentage of exposure of an overall program or portfolio, only modestly worried about dollar-related exposure. US investors have the real benefit of the dollar being sort of the world's reserve currency. And despite its recent weakness, of course, it's had a rebound over the course of the last 10 days, given the move in the 10-year US Treasury, inflation expectations, and a sort of a broader expectation of recovery in the developed economies on a global basis. And so, I think investors are thoughtful about, let me put it this way, David, they're more nimble on the currency related issue in, say, public market transactions or public market securities than they are concerned about it from a direct or private equity related perspective. And that's, of course, because of the time horizon, which is, of course, quite long generally, and their sort of propensity to spend in US dollars. So.
Okay, well, many thanks. Well, Matt, let's just come to you for some closing comments. For those tuned in, what are the sort of key takeaways from the session that we just discussed?
Well, I think the key takeaways are, at least from, I guess the U.S. is open for business. There's been a lot of deal activity here. I think it'll continue as people get more comfortable in how to invest. And listen, people aren't meeting personally anymore, and I think that does affect, at least initially, the deal environment. But now, I think as you see people getting more comfortable and having cash on the sidelines, it needs to be deployed somewhere in the U.S. given the relative stability that we have in the world, the dollar currency, people's familiarity with the jurisdiction. I think dollars and family investments will continue to flow to the U.S. And I think you just have to have the right team from a tax, legal, and business perspective to guide you through the process for all the reasons we've discussed.
Okay, many thanks. And Brooks, any closing comments as we wrap up this hour?
I think that it would behoove anybody who's looking to come into the United States as a control investor, investing in private companies, to have a fully thought out, essentially package of information, so that when that first voice of that first voice of uncertainty comes out and says, are you really the right partner for us? You're in a position to say, yes, I am, and here's why, and here's everything that you need to know about me and how I operate in order for you to get to a successfully closed transaction quickly. Shut down the voices of uncertainty as quickly and as decisively as you can, as early as you can in the process. And that is going to massively increase your likelihood of being a successful transaction party with US domestic sellers.
Okay, well, many thanks for joining us this afternoon. Thank you to Matt and to Katten for sponsoring this session, and we look forward to sharing with you future US content that's of interest to private wealth advisors. So thank you to the panel, terrific discussion, and I wish you a good afternoon.